Welcome to this edition of PE Forum. Today we are in Zug, in the House of Private Equity, with Dr. Bernd Pfister, one of the most seasoned and respected figures in European private equity. He is chairman of Paros Capital, as well as chairman of SECA, the Swiss Private Equity and Corporate Finance Association, and vice chairman of the Swiss Venture Capital Association. Over the past 3 decades, Dr. Pfister has been involved in more than 150 transactions in private equity. He serves today on the board of 25 companies and overall has served in 65 public and private enterprises throughout his career, always bringing a wealth of experience in deal-making, governance, and strategic growth to these companies, and this is something that we will discuss today. Dr. Pfister, thank you so much for taking the time with PE Forum today.
Yeah, thank you very much for having me.
So our first question would be around the Swiss private equity environment. What is the leading description for the dynamics that is going on for private equity in Switzerland today in relation with its neighborhood?
The private equity industry is a success story in itself. I mean, we have now more than 60 venture capital funds open for investment and 2.5 billion Swiss francs invested last year on the early stage side. And there are very well established private equity houses doing mostly small and mid-market deals. And when I compare that to the 90s, when I wrote my PhD on venture capital and the private equity industries, it was really hard to find an interview partner. There was nobody around. Nobody did a deal. And now we have a very thriving industry. It's growing. Performance has been established, and there are high-quality, seasoned managers in Switzerland.
And so if we dig a little bit more, is there a specificity to Swiss private equity firms, or is it a diverse collection like everywhere else in the world?
You know, the Swiss private equity landscape has some, specialties. On the private equity side, about 2/3 of the invested dollars end up in technology, industrial, and infrastructure, including energy and data center investments nowadays. So if you, as a pension fund, invest $1 in private equity, you are not buying the Swiss GDP growth of 1-2%. You really buy a portfolio of companies which grow more like 8 to 9% top line, because that's where the GPs want to deploy their capital.
And when we think of Switzerland, we think also of high net worth individuals, family offices, whether it's in Zurich or Geneva. These are wealth capitals. What do you see their role within the Swiss ecosystem? Are they well integrated and involved within PE firms that are based in Switzerland, or are they more looking to invest in firms that are outside of Switzerland?
I think both is true. One is it is very clear that a lot of private equity funds are backed by high net worth individuals, and some of the wealth management banks here in Switzerland, I think the total number is now they manage like 40% of the non-domestic worldwide assets. So a lot of investments come out of the private banks into fund of funds typically. They invest in Switzerland as well, but usually in a global mandate, so with diversification. However, family offices have a very critical role on the early stage side of the spectrum. pre-seed, seed rounds, also venture capital funds are collecting most of their money not from institutions and the pension funds. They are more cautious here in Switzerland. So in this gap, the family offices have a big stake, and they do also direct investments in startups. Where we have a problem is once the Series A, Series B arrives, and larger tickets of like 20, 40 million Swiss francs are needed to accelerate the growth, or do an add-on acquisition. There we still struggle to finance these deals locally, and typically in that round we get some European or US investors in, which leads the rounds.
It's this Series B that you mentioned, I think, is a bottleneck for many geographies where, when the larger end, and maybe where the US has an advantage on Europe or other regions, is that pension funds might go in with the VCs that finance this round. Speaking of direct deals, and as well as the tech environment that you mentioned, what do you see is a missing link, or are you seeing that there's a good integration for Switzerland today within the entire European VC sector?
Yeah, we are as SECA working very closely with Invest Europe together. Mm-hmm. We also send our delegates to Luxembourg and Brussels. We are involved in proactively influencing European legislation, and obviously lobbying very hard in Bernd to mitigate the Swiss finish on some litigation legislations. However, Switzerland has its own ecosystem, mm-hmm. and there are always things to improve.
But for you, do you see a positive point into keeping this Swiss specificity, or would you like more, agreements in, let's say, passporting right to be able to fundraise, or in terms of also being able to do more deals so that the PE and VC firms that are located here, can expand a little bit, or do you think that this is the way it is and you have to deal with it?
Yeah, I think in most part it is the way it is, and we have to deal with some specialities mm-hmm. of Switzerland. It has also, some disadvantages, but also some advantages. Mm-hmm. And on the positive note, we participate in a lot of innovation programs, and as I mentioned, we work with Invest Europe on the framework lobbying. So I think we are well located, and with some respect in terms of the strong Swiss franc is always a performance blocker, if you like, if you build up export-oriented startups, or mm-hmm. Your performance is measured in Swiss franc. So every invested dollar in Europe, which sometimes is more than 50% of the portfolios, mm-hmm. has to re-earn the currency fluctuations. But we are well integrated, and Switzerland has some distinctive advantages against some European alternatives. One being that people are looking to invest in a stable currency, in a stable political system, and the government is well run. Switzerland has a 17% debt to GDP ratio, but if you look at the liquid asset side of the government, they could cover the debt next year, and it's basically debt free, which is in a world where government debt are becoming a huge issue and competitive advantage, which will play in our cards over the long term, I think.
Which is starting to show in the current environment that we're in. And so if we look at specific sectors in the coming, 5 to 10 years, which, is a minimum cycle for private equity, are there specific sectors that you think Switzerland is and Swiss PE firms are well positioned in?
Yes, I mean, if you look at the world, since the COVID crisis, where global supply chains, broke down, and having these tariff discussions, with the US in the moment, companies are looking to diversify their supply chains, and they look for a second option, and they are more willing to invest a little bit more money into supply sources in Switzerland. So advanced industrial products, also biosimilars are a long-term growth potential, which will stick for us for the long term. I mean, companies in the public space like Siegfried or Lonza are performing very well, and a lot of services around these companies or new startups are gaining a lot of attention right now. I think that's a long-term trend, and we could benefit from that here in Switzerland in sort of being the secure sourcing hub, or at least a second sourcing hub against places like the US or Asia.
If we move on from this macro vision to a more micro vision, for you in terms of opportunities, is it more within the new startups that you mentioned, or within what is happening all across Europe, which is a generational transfer and management that might change? Where do you see the biggest opportunity for private capital? Is it more in the startups or in a generational passage in a SME that has been doing something for the past decades?
A good question. I think that the opportunity sets and various strategies are very attractive in Switzerland. In the buyout space, the industrial base in Switzerland is very strong. And yes, we do have to manage the handover of industrial companies, and private equity can play a significant role in that area. On the other hand, Switzerland is a hub of high technology. The ETH Zurich is world leading in semiconductors, in robotics, and mechanical engineering. Therefore, the potential for spin-offs and early stage companies, deep tech, is very significant. So venture capital, in my view, is a big potential in Switzerland. We invested last year 2.5 billion Swiss francs, down from 4 billion in 2021. That was a very high investment year. I think we have capacity to deploy 4 to 5 billion a year in venture capital, and we should do so, because that's where the growth come from and the high value added jobs of the future. And we also need to invest more in the digital infrastructure to stay competitive and embrace the opportunities of artificial intelligence.
Very clear. And so, if we move on, you founded a lot of asset managers throughout your career. Today, with Paros Capital, what was your main focus, and what do you hope to achieve?
With Paros Capital, I invest it's a principal investment vehicle. I invest my own capital. I have a few friends, family offices which co-invest with me. And it was also, if you like, a lifestyle decision. I started in the industry early 90s, and I had a few experiences in asset management companies, and in 2010 I said it's time to deploy my own capital in a principal investment strategy rather than to become an asset gatherer and earn our fees and carry, which is a valuable strategy as well, but it's a different lifestyle. If you raise billions of dollars and you have to invest them in 3 to 4 years and then divest, you spend 40% of your time talking to LPs, 30% managing a business, marketing, people's management. You have to enhance talent, and you can only spend 15-20% on making deals, and that's what I wanted to do. Therefore, Paros was an ideal vehicle for me.
So if we think about the DNA for you, is the deal making and focusing on the DNA and more on the enhancing and operation of the companies you invest in?
Yes, yeah. I rather have a small portfolio of buyouts, and we have also a portfolio of early stage venture co-investments and funds, and that has served us very well. And I obviously try to pull all levers to increase the output and efficiency of the portfolio companies, and luckily enough we have been successful in doing so.
And so how do you see the value creation when you compare a role of an investor or being on the board of a company like you do? I mean, can we still make a difference in the board of a company today?
Yes, I think we can make a big difference, and I think private equity is particularly well suited to create value, because it has it has the ability to align the interests of the management and the investor much better than maybe public companies. We involve the management teams of us in the shareholder structure always, and if you set targets in terms of exits or milestones for strategic objectives, everyone in the company can benefit, and if it doesn't work, everyone feels it as well, and that's this alignment of interest is a special feature from private equity, which is, I think, very beneficial.
And so if let's say we look into a Pfister deal today, what sectors are we talking about? What type of transaction do you seek?
I seek to invest in light business models. Having said that, think about advanced services. We have Argus Data Insights, for example, which is a leader in media intelligence in Switzerland and Germany. We have subsidiaries in France and Spain, which we expand now. Or Infogard, a cybersecurity company, where we have a co-investment, or Libera, the largest pension fund auditing company in Switzerland, with about 200 billion pension fund assets under advisory.
And so if we dig in a little bit more into the environment of the private equity, you mentioned, you know, the management fees and how it is structured. Do you feel that with everything that is being said around the late exits and, you know, the continuation funds, there have been some criticism from some LPs. Do you think it is somewhere where still interests are aligned between LPs and GPs when you see continuation funds, or do you think that there might be some risks there?
You know, there's always a risk of conflict of interest if you have a crossover of one asset into another vehicle which is managed by the same GP. Mm-hmm. However, I don't think this is a big issue, because it creates liquidity for the LPs. You know, they can choose if they want to roll over their investment into the new vehicle or exit the asset at a certain price. And obviously, the preferred route of exiting would be an auction process or an IPO. However, the market over the last 3 years has a lower exit rate. Historically, from Cambridge Associates, the exit rates on buyout portfolios is like 25% on average. In 2021, which was a huge year, there was like almost 30% of the values coming back. So a lot of people had money and distributions coming in. So a lot of deals were done in 2021. However, since then, interest rates went up. We have also now tariff discussions where a lot of M&A activity was postponed. And we have now a run rate of roughly 16% of distributions, which is almost 50% below historical levels. So LPs are feeling the squeeze. Mm-hmm. They are not getting enough cash flow out of the portfolios to do fresh deals or pay for drawdowns. And that's creating, obviously, some tensions. And in this environment, if a GP feels, okay, I cannot sell these 3 companies now in the open market because the M&A opportunity is not there, I think it's a fair solution to package these 3 deals in a secondary transaction, bring some new investors in, and then give the LPs the opportunity to take liquidity out. And yes, the prices might be not top notch, mm-hmm. Maybe a little discount to the net asset value, but I think that's fair enough. So I don't see a big problem in this type of transactions, because the main focus is to give liquidity to the LPs. Mm-hmm. There are obviously conflict of interests in related party transactions, but you know, the advisory board and the governance structure usually is capable of dealing with such a transaction, and I'm fine with that.
Do you think that the lack of exit is a risk on the private equity industry? You know, if you read some newspaper, they depict sometimes private equity as being the next bubble about to burst. What would you say to these headlines? What would be your answer to these headlines?
That's not the case. The private equity industry is very healthy, and the deployment rates are relatively stable. It is true that there are 29,000 private equity companies in the portfolios now, and roughly 45 to 50% of this inventory is more than 4 years in the private equity ownership. However, that's not a huge distortion from historical levels, and I think the inventory will be worked through over time. And for example, last year we had 20,000 private equity transactions. That's not exits, but transactions going on. That was financing rounds, refinancings, and so forth. So at that rate, a lot of the existing portfolio is turned over every year, and I don't see this is as a critical issue for our industry. And I must also say that the world economy is potentially on the edge of a recession. China is in a difficult situation. They have a balance sheet deflation going on in the real estate sector. The US with the tariffs have some growth issues going into 26. So there is some there is some risk of a global slowdown. And private equity assets are very well suited for these slowdowns. Usually we outperform in weak markets. I don't like weak markets, but I do like the prices they create. And the private equity industry has about $1.5 trillion in dry powder in the funds. And usually if things slow down a little bit, then they can take the opportunity for add-on acquisitions. They can buy cheaper assets, and they can invest in companies for innovation projects, whereas the competition might not have the funds or access to the capital market at that time. And that improves the competitive position of the portfolio companies we have in the inventory. Therefore, I'm quite optimistic in the moment. And historically, in vintage years where there was low M&A volumes and not so clear economic environment, it would take historically good vintage years because less capital was chasing less deals, and the industry ends up with higher quality assets. So I'm quite constructive.
There's been a blend between the business of asset manager, wealth manager, and private equity, especially when it comes to secondary deals. And we're noticing a larger growing of AUM of certain firms, reaching high level. Do you think that this consolidation might change the nature of the private equity with a reduced number of actors, or no?
The private equity universe, has been changing over the last 30 years a lot, and this process is not stopping here. We have firms like Blackstone, which announced a $500 billion investment program into Europe, which is nice, in various strategies. Especially you have then huge companies like Equity from Sweden, which announced the large shift into infrastructure investments. That's also a new area of deployment. I saw the rise of real estate deals and the private real estate asset class evolving. And there's still lots of growth potential there as well. So I personally, I'm not worried that we are, in a tricky place in the moment. What I see is there's a lot of change always going on, and the industry has been very adaptive, very innovative, and assets under management moved. In 2000, we had not $1 trillion invested in private equity, all strategies, including venture capital and private equity, and now there's about 15 to 16 trillion US dollars invested. And my personal reading is that we will have north of 30 trillion US dollars invested in private equity strategies in 2030. And that's also private debt, which is growing a lot, infrastructure, real estate, then the classical buyout and venture strategies. So I'm quite optimistic.
And so the other point I wanted to follow up on is also the theme of emerging managers. And so how do you see this particular segment, and on a personal level, obviously, and also within the Private Equity Association?
Starvation focuses the mind, and young managers, first-time funds, have to prove that they are capable and they are very hungry. And therefore, I'm quite, open to invest also in young teams. There might be a lack of experience or track record, not everything perfect, but this motivation actually pays a lot of bills. Therefore, I'm quite optimistic there. I see in Switzerland a constant flow of startups and either spin-offs from established buyout houses, or teams in the venture space going out. I think we have like 60 open venture capital funds now in Switzerland raising capital for very innovative strategies, from environmental to biotech and deep tech funds. So it's a diverse bag.
Interesting. And so we've mentioned you've done in excess of 150 transactions. What keeps you energized today when you look at private equity? Is it seeing these new emerging manager, or is it certain sectors? What motivates you as chairman of the SECA, or in your capacity at Paros Capital?
No, I'm a very curious person, and I really love my business. So as Warren Buffett said, I'm dancing to my office every day, and I very much like to look at the innovative frontier where these startup businesses evolve, or AI applications which we bring into our established businesses to improve productivity. I love to work with young people. That keeps me going. And I am always open-minded to new ideas, and I think doing transactions, creating platform companies, and integrate like 10, 15 add-on acquisitions on these platforms is an exceptionally interesting process, and it creates value, but is also very satisfying if you see that the team is successful, and at the end, then the financial returns are actually coming home.
You play many roles. You founder, board member, chairman, investor. Of all these roles, which is the one that is for you the most rewarding?
I love the investor head. I'm a principal investor, and I like the art of the deal. However, my role is in the boards are more like a coach. Also, I like that as well, building up good management teams which are capable of succeeding, diverse teams, and but this is the most challenging bit of my business, because sometimes one person is a great talent, however doesn't fit into the team at this juncture, and you have to exchange then and build teams or bring new talent in, and it's hard to be always in the forefront of this process. Usually I'm a little late, and but it's an interesting challenge, and I always loved what I did.
And so when you started out, in private capital, is there something that you believed that you no longer believe in today, or has it been a validation and confirmation of what you expected of this line of business?
I'm learning every day, and I always thought, at the beginning, I thought it would be easier to raise funds. It's not easy. Easier to find deals. It's not easy. And easy to execute a certain strategy if you just thought hard enough. And that's not an easy one, because life has always challenges, and the environment reacts, competitors are fearful, so you have to be flexible and always live up to your challenges. And there are good times and bad times, especially in the venture area. I invested since 30 years there, and statistically 4% of the invested dollars are responsible for more than 80% of the returns. So you have to kiss a lot of frogs to find a princess, and that's what I'm doing. Interestingly, I just recently looked at my personal performance, and my buyout performance and venture is actually very similar. Okay. But over the long term, over a 30-year period, if you like. However, the buyout performance is much more stable. And the venture, you have some ups and downs, and sometimes you have to live through years, like 3 or 4 years, where you have little returns and a lot of companies to feed through. So the cycle is quite significant.
And so after you invest now in through Paros Capital, and after you support the private equity ecosystem in Switzerland, do you have time for anything else?
Yes, I have a family. I'm very much involved in supporting the University of St. Gallen, where I studied, and both of my sons are studying there as well, and my godchild is also doing the master there. And I do sports, and I try to relax from time to time. But I don't feel that my work is putting too much pressure on me. I mean, I've sometimes decisions to take which are difficult, but I love what I do, and as long as that's the case, I go and I go with full energy.
So you said that private equity ended up being more difficult than what you expected. Would you advise to newcomers to stay in this business or to find something else? And if you advise them to stay, what guidance could you give them?
It's a good question. You need staying power, and you need to be aware of the challenges which might be waiting for you, especially in the early stage area. As I mentioned, only 4% of the companies really succeed. That means that you might be the CEO of one of the 96% companies which are not the roaring success out there. And also career in the classical private equity industry evolved over the last 20 years and is now much more institutionalized. In some of the houses, it's more like the classical asset allocation and more like an institutional career rather than the entrepreneurial spirit of the 80s and 90s. KKR. It was a very small buyout shop, and in the 80s, and now they have 200 billion assets under management and are a member of the Standard & Poor's 500. So the industry has changed a lot. But I like the industry. As I mentioned, I think that the assets under management will double over the next 5 years, which is a healthy cliff. Therefore, there's not enough opportunity in the industry to succeed. Not everyone has the means and guts to be successful. That's also an advice.
Mm-hmm. And so just to go back on your point about the difference between venture investing and growth, if you look at your portfolio construction, so how do you go about it, and were they mostly the winners that you thought were the winners became the winners, or not always?
Always, if I sign the check, I think I have a winner. And 5 years later, I can tell you if I was right or wrong. And it is very hard to, even in buyout deals with established businesses, large customer bases, and solid cash flows, it is very hard to manage the upside volatility. Mm-hmm. I don't think that anyone knows that. You don't know if it's a 2x or a 10x deal in front of you. Where the management of a private equity house really kicks in is the downside, is the management of the downside risk. In venture capital, the good venture capitalists, they really act like gardeners. They, kill the weed and put water to the roses. So you are backing the winners, and that's a difficult task because you have 20, 30 companies in your portfolio. And usually the successful companies, the real winners in your portfolio, they don't call, they don't need your help, they make their budget. So what? But that's where you should put most of your attention to accelerate them, to hyperscale these businesses, and actually to deploy 2 times, 3 times more capital to the winners. And then you have companies which don't make the budgets, need more capital, have problems with the management team, problems with the market, and so forth, and they are screaming very loud, and they need management attention. They eat up time and capital, and the good investor obviously allocates time and attention to the winner and not to the problem case, which is from a psychological point of view a very difficult feat. I think that is something a portfolio manager in the private equity space needs to bring with them. You have to focus on backing the winners, and if you see a winner, you have to go all in and try to increase your stake so that this successful company can pay back your fund or twice the fund, because you don't have too many winners.
So do you think you need to put sometimes, when you construct your portfolio, your ego aside? Because usually if you spend time with companies that has problem, it's also to try and have a full successful lineup.
Yeah, one of the common mistakes is to fall in love with the business concept X or Y. You have to take your decision data driven. The numbers don't lie, and you have to focus your attention to the businesses which have the highest upside potential, and try to asset allocate into these areas. It's not easy, there's always a potential for setbacks, but it's a very important process, and it's very important that you are very structured in that way, and I personally allocate every quarter, and I try to put the fresh money into the deals which move in my direction.
And so, if you hadn't been in finance and private equity, what career would you have pursued?
I studied, next to the St. Gall University, bachelor, master, and PhD, for 4 semesters biology in Germany. That would have been also an interesting area of science. I always liked biology, especially genetics and biosimilars and these more healthcare related areas. Currently, I'm not investing in biotech because that's really a very special field and very risky, and I'm too small to sustain the risk levels there. But I like that space, and I have a portfolio of around 50-60 co-investments in aquaculture, so seaweed, algae, fish farms, and deep tech in the aquaculture industry, together with an accelerator program and a venture capital fund, and I really like that particular sector, if you like. This is not mainstream. It's not the fastest moving space, but I think I believe in the long-term merits, and also the ecological necessity to invest there. We want to give the world population enough healthy proteins, and we cannot sustain 50% of wild catch in the oceans to feed our populations. Therefore, I think we have to naturally increase our production in aquaculture and enhance it with maybe seaweed or algae, and that's a big potential growth sector, and fits my biology as well.
So I guess the common denominator would be asking the right question, whether it is in both business, whether the private equity, asking yourself if it's a good investment, and biology, and science, where it's about, asking the right question and putting the right hypothesis at the forefront in order to answer. So, Dr. Pfister, thank you very much for your time. It was a very insightful conversation.
Yeah, thank you very much. Always welcome, and thank you very much for having me.